Hi believers, this is Nishant from the Waya team. Today we will discuss the major indices and the markets for the month ahead. As always, we will review the charts of major indices and also valuations of Indian markets in order to understand how we should be placed in the month of July. Starting with the Nifty 50 index, we have observed a smooth rally from 23,500 to 24,000 in the last 5 trading sessions. However, Friday's closing is not convincing enough. Let me show you the reasons on the chart itself. On the daily chart, the Nifty has formed a shooting star. On the weekly time frame, we have 1.618 Fibonacci resistance. And on the monthly time frame, we have a hanging man pattern with heated RSI of 80. These three time frames are indicating a probable pause. To invalidate these patterns, a strong weekly close above 24,200 is required to rally towards 25,000. Moving to Bank Nifty. Similar to Nifty, Bank Nifty has seen a smooth rally from 50,000 to 53,000. And it shows similar candlestick pattern and Fibonacci resistance like Nifty. The daily chart shows an evening star pattern. The weekly chart indicates Fibonacci resistance and the monthly chart is showing us the hanging man pattern, further reinforced by a trendline resistance dating back from 2018. Considering these factors, there may be a halt in Bank Nifty's rally too. To counter this view, Bank Nifty needs a strong close above 53,200. However, we believe banks have more room on the upside due to multiple other reasons, which we will discuss. Moving to CNX 500, this index is crucial as it represents the broader market compared to Nifty and Bank Nifty. Like the Nifty and Bank Nifty, CNX has formed a bearish candlestick pattern. In this case, it is a shooting star. On the weekly time frame, CNX 500 has a Fibo resistance. It is very strong resistance for CNX 500. And on the monthly time frame, the index has formed an hanging man with very heated RSI levels above 80. We have touched upon the technical studies of these three indices, Nifty, Bank Nifty and CNX 500. But the technicals gives you directions only particular levels are being crossed on the upside or the downside, which confirms your bearish or bullish patterns. Therefore, it is important to look at the valuations and the other data points which also supports your analysis. That is why right now we are looking at the valuation of these three major indices. Let's look at the valuation of Nifty 50 measured by trailing price to earning ratio. The green line indicates the Nifty index price. The pink line indicates the valuation of Nifty 50 measured by price to earning ratio. The black line is showing you the recent peaks of Nifty 50, which is at 23.5. At present, the valuation of Nifty based on trailing PE stands at 22.85, which itself tells you that there's a very limited room for the upside. Now we can connect the dot that on the charts based on technical study, Nifty chart was showing very limited upside and in the valuations as well, the upside is limited. Moving to the valuation of Nifty 500 index measured by the trailing price to earning ratio. In this case, the recent peak of the valuation has been crossed. That means CNX 500, which is Nifty 500, is become more expensive. At the same time on the chart, we have seen that Nifty 500 has a very strong Fibo resistance and on the monthly chart as well, it has crossed 80 RSI levels. Moving to the valuation of the Bank Nifty. Bank Nifty's valuation measured by trailing price to book ratio still has sufficient room. We can see that the peak valuation of the Bank Nifty is around 3.2x. Right now, we are standing at somewhere at around 3, which gives us a good room of 8 to 10%. Concluding our analysis, the numbers and the charts we discussed, it appears that small and mid-cap stocks may face challenges ahead, while non-financial large-cap stocks have limited upside. Large-cap banks, especially the private ones, may continue to rally. Therefore, it is advisable to focus on selecting large-cap companies with forward-looking business models, such as Reliance, Bharti Airtel, L&T among others. Additionally, focus on banking and two-wheeler stocks as these sectors are expected to perform well going forward. As we enter the result season, market reactions and stock specific actions will dominate. The earnings may come below expectation because of slowdown in orders and spending from government, as businesses also hold on to critical decision making due to possible policy changes post elections. It is important to note that we do not expect a severe fall, but to be cautious enough and add stocks in price correction. Therefore, investors should focus on thoroughly researched stocks rather than chasing momentum. As always, Indian markets is a structural story and it remains buy on dips for next couple of years. At Vaya, we make our best efforts to keep you informed about markets through our weekly bite and sectoral update. Thank you and good night.